So you're saving, investing, doing all the right things, but your portfolio still underperforms. Why? It's not Wall Street. It's not the algorithm. It's you. Today, we're exposing the invisible psychological traps that quietly sabotage your investments and how to outsmart them one mindset shift at a time. You may be familiar with the classic Benjamin Graham quote, "In the short run, the stock market is a voting machine. In the long run, however, the stock market is a weighing machine." So grab a pen and paper, settle in, and let's get started. Imagine you see a 10% drop in your portfolio today. Are you going to panic sell? Depending on your investment strategy and goals, a 10% dip could be normal. For example, if you invested in growth stocks, which historically experience higher volatility, then a 10% correction might be within expectations. First, trust history. Since 1950, there have been 26 bear markets, meaning the stock market dropped 20% or more during that period. On average, bear markets declined by 33% and lasted 363 days, but every single one of them eventually recovered. Second, use dollar-cost averaging. We often hear experts saying time in the market beats time in the market. Jack Bogle said it best, "Don't look for the needle in the haystack. Just buy the haystack." How long can I afford to invest this money without needing it? What if this drops 20%? Can I still sleep at night? Is this investment suitable for my overall portfolio? Have I done my research, and if so, where can I find the sources? Buying a low-cost index fund allows you to own the entire stock market in one simple position. First, ask yourself, would I still invest in this if I didn't hear about it on TikTok? For example, Dogecoin started as a joke. But since then, its price has skyrocketed and crashed multiple times. Would you still bet on it? And remember, the best time to plant a tree was 20 years ago. The second best time is now. See you soon. If you're not the first to hear about the trade, second, create a rule-based investing checklist. Ask yourself 3 questions before investing. Understand the business, have a long-term thesis, and fit within my risk profile. Third, limit your speculative bets to 5% or less of your portfolio. If you really want to buy that speculative stock, limit your exposure so that if it goes to zero, you won't lose sleep over it. Second, track your decisions in an investing journal. Write down why you bought a stock, when you bought it, and what your thesis is. You join in too, but unfortunately, you enter at the top and lose money. Fear of missing out, or FOMO, is one of the biggest drivers of herd behavior. But the truth is that the enemy is not outside, it's inside. To win the battle against your own mind, arm yourself with knowledge and practice. Ask yourself which trap you've fallen into and what you've learned from it. Share your story in the comments. And remember, it's not the market, it's you. And with a bit of awareness and preparation, you can overcome these traps and achieve long-term success in the market. It compels you to buy the hottest stock because you feel that you could also be the next big winner. But more often than not, you just end up like the person in the meme stock example. You'll be surprised by how many bad trades you've made. Third, admit what you don't know. Warren Buffett is worth $120 billion. He's one of the most successful investors of our generation. But Buffett famously said, "I will tell you what I do not know. I do not know how much longer I will be able to function at the level I am functioning now. I don't know whether there'll be another shoe that will drop in the financial world. I do not know whether I am gonna have a heart attack tomorrow or the next day." And according to Dalbar, since 1988, a $1,000 invested in the S&P 500 would have grown to nearly $8,000 by 2018 if you had just held on. But if you tried to time the market by withdrawing and reinvesting your money 10 times, your $1,000 would have grown to just $5,000. Essentially, timing the market doesn't pay off. And when you time the market, you only make yourself feel like a genius if you happen to guess right once or twice. Third, don't overreact to news headlines. There's always something negative going on in the world. In 2020, it was COVID. In 2021, it was supply chain issues. In 2022, it was inflation. But long-term investors just tune it out. Focus on the businesses you own rather than the noise in the news. If you zoom in too much, any drop looks huge. But if you zoom out, even double-digit drops become insignificant compared to the long-term trend. Second, invest automatically. People who set and forget their investments outperform those who trade frequently. Why? Because frequent trading is driven by emotions. You watched a few YouTube videos, and now you think you're the next Warren Buffett. You start picking individual stocks, but instead of carefully analyzing companies, you jump from one hot stock to another. One day you find a penny stock that has doubled in a week and assume it's going to keep rising. You throw your whole portfolio at it, and within days, the stock tanks. According to Dalbar's study mentioned earlier, the typical investor buys after a market peak and sells after a market trough, locking in losses and missing out on subsequent growth. Third, remind yourself that temporary dips don't equal permanent loss. When you see your investment drop in price, ask yourself, is the business performing worse today than it was yesterday? Probably not. Then remind yourself that the stock price will recover and focus on the bigger picture. What he means is that in the short term, stock prices reflect public sentiment, fear, greed, hype. When the past week feels like the future, you start saving and investing for retirement. One day, you read the newspaper and discover that the S&P 500 has gained 15% in the past year. You think, wow, maybe I should have invested earlier. Actually, you would have been better off if you had. Since 1980, the S&P 500 has had an average annual return of around 8%. So if you miss the best days of the market, your returns will be significantly lower. Unfortunately, this is exactly what recency bias does. It tricks you into thinking that recent performance will continue. After the 2008 crash, many investors stayed in cash for years, believing that the next crash was just around the corner. As a result, they missed out on the greatest bull run in stock market history. But over time, these sentiments even out and fundamentals take over. Yet while this makes intuitive sense, very few investors actually behave this way. In fact, a 2012 Dalbar study found that the average equity investor only earns half of the return of the market. The reason, behavioral finance suggests, is that we are our own worst enemies. Our everyday decisions are controlled by mental shortcuts and hidden biases that we are not even aware of, and this can cost us thousands over our lifetime. So what are those traps? And more importantly, how can we outsmart them? That's what we'll explore today. We will discuss 4 common investment mindsets that hold you back and reveal actionable tips to overcome them. Trap number 1. Loss aversion. Why losing hurts more than winning helps. Imagine this. You've just made your first investment. You watch it grow 20% in a few weeks and feel like a genius. But then it drops 10%. Suddenly, you're worried and wish you'd sold before the drop. By the time it recovers to break even, you're so anxious about the ups and downs that you sell your entire position. So after one winning trade, you walked away with nothing. Does this sound familiar? You're not alone. According to Daniel Gilbert, a professor of marketing at Duke University, loss aversion is a universal human bias. It means that we feel the pain of losing money twice as intensely as the joy of making the same amount. That's why investors sometimes prefer guaranteed small gains rather than taking risks for big gains. Or why some people only invest in safe assets like bonds or savings accounts, despite knowing that inflation will erode the value of their holdings over time. In a nutshell, loss aversion is why many investors sell too early or don't invest at all. So here's how to outsmart this trap. First, zoom out your time horizon. Trap number 2. Recency bias. Imagine you've just graduated university and entered the workforce. So here's how to fight back against recency bias. Trap number 3. Overconfidence. Thinking you're the next Warren Buffett? Imagine you've just read a book by a famous investor. So how do you outsmart overconfidence? First, stick to a boring, diversified plan. Here are some questions you can ask yourself before making an investment. What's my time horizon? And now for the final trap. Trap number 4. FOMO and herd behavior. When everyone's buying, you feel you should. To imagine you're browsing TikTok and see a video about how someone made thousands investing in a meme stock. So here's how to avoid FOMO and herd behavior. It's easy to blame Wall Street, the algorithm, or anyone else for your poor investment returns. If you liked this video, check out this one next.